Ladies and gentlemen, good day and welcome to the Krishca Staffing Solutions Limited H2 FY25 earnings conference call, hosted by AKMIL Strategic Advisors. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touch-tone phone. I now hand the conference over to Mr. Sahil Patil from AKMIL Strategic Advisors. Thank you, and over to you, sir.
Good afternoon, and thank you. On behalf of AKMIL Strategic Advisors, I welcome you all to the conference call of Krishca Staffing Solutions Limited. From the management side, we have with us Mr. Lenin Krishnamurthy Balamanikandan, Chairman and Managing Director, Ms. Jagajyoti Naskar, CEO and Whole-Time Director, Ms. Diya Venkatesan, Company Secretary and Company Officer. Now I hand over the call to Ms. Diya. Over to you, ma'am.
Thank you, sir. Good evening, everyone. Thank you for joining us today. I would like to welcome all our investors, analysts, and stakeholders to the H2 Financial Year 25 earnings conference call of Krishca Staffing Solutions Limited. I'm Diya Venkatesan, Company Secretary and Compliance Officer of the company. I'm joined today by Mr. Lenin Krishnamurthy Balamanikandan, our Chairman and Managing Director, and Mr. Jagajyoti Naskar, Full-Time Director and Chief Executive Officer. We are also accompanied by key members of our leadership team. Together, we will walk you through the company's performance for the second half of Financial Year 25 and for the Financial Year 24-25. Highlight strategic developments during the period and share our vision and priorities for the road ahead. Company overview and performance highlights. At Krishca Staffing Solutions, we are driven by our commitment to excellence in our providing comprehensive packaging solutions for the metal industry. In Financial Year 25, Krishca Staffing Solutions Limited recorded revenue of rupees 151.08 crore, which is a 43% growth in revenue compared to last year, reflecting the stability of our business model and our ongoing efforts to strengthen our presence in the industry. Despite sliding steel price and pressure from the international steel pricing situation in this financial year, our EBITDA stood at 24.29 crore, which is a 20% growth year-on-year. Strategic investments and diversification. The new cold rolling complex project is progressing as per the original timeline with major machinery orders completed. Factory construction is scheduled to begin in this month, with production expected to commence by Q4 of Financial Year 26. In addition to expanding our steel production capabilities, we are strategically diversifying into other packaging materials. We are increasing our focus on comprehensive packaging solutions, including products like desiccants, tarpaulins, HDPE materials, airbags, and a range of BCI-based corrosion protection products. This expanded product portfolio will enable us to provide better packaging contract services, as we will be using all these items in the various packaging contracts we are expecting to secure. By broadening our product offerings, we are enhancing the value we deliver to our clients and reinforcing our competitive edge in the global market. Strategic contracts and expansion initiatives. Our commitment to growth is further evidenced by the significant contracts we have secured. Our revenue from packaging contract business, which stood at rupees 3.16 crore in Financial Year 24, has grown substantially to rupees 12.88 crore in Financial Year 25. As on date, our packaging contract order book is rupees 50.79 crore in confirmed orders for Financial Year 26 and rupees 120.89 crore for the next 3 years, ensuring strong revenue visibility moving forward. Future growth and market position. Looking ahead, our goal is to sustain our growth trajectory, with revenue expected to grow by 25% in financial year 26. Increased order book in our packaging contracts is expected to be a key driver of this growth. The increased product portfolio of other materials will enable us to provide better packaging contract services. This strategic approach not only enhances the value we offer to our clients, but also positions us to capture a large share of the market. Our emphasis on expanding packaging contracts and penetrating high-growth regions positions us as well for future success. We are confident that our investments, both planned and ongoing, in the special steel production facility and diversification into other packaging materials will enable us to meet the evolving needs of our customers and stay ahead in a competitive market. These initiatives are integral to our long-term strategy of building a resilient and diversified business model. In conclusion, these results reflect the dedication of our team and the progress of our ongoing initiatives. With solid future expansion plans, a strong order book, substantial market reach, and industry-leading operational standards, Krishca Strapping Solutions is well positioned to continue building on our legacy of quality, innovation, and growth. We remain committed to creating sustained value, and we are excited about the opportunities ahead. We are grateful for your continued trust and support. We are happy to address any questions and provide additional insights into our journey. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question, you may press star and one on your touch-tone telephone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to all participants, if you wish to ask any questions, you may press star and one. We have a first question from the line of Rahil Dasani from MAPL. Please go ahead.
Yeah, hi, I'm audible.
Yes, sir.
Yeah, hi, Raghu. Audible. Yeah, good afternoon, sir. Thank you for this opportunity. I have several questions. So first of all, what is the purchase of stock in trade of 26 crores? Did this quarter have some revenue of trading of some products and hence this expense? So if you can please explain this.
Yeah, hi, good evening. See, as part of, the packing contract, we not only deal steel strapping, we also deal various other packaging material. So all our customers, they also use these other packing materials. So we deal with products like HTP, VCI-based products, and lot of dunnage airbags, tarpaulin. So this it was very revenue was very less last financial year. So from this year it was a bit higher. That's why we have given a separate column in the balance sheet to distinguish the revenue.
Understood. Okay. And secondly, I believe in last call you said that you guys will also start manufacturing these primary packaging products. So what's the timeline for that? Would that also be coming with the cold rolling plant, or will we start that primary packaging plant earlier?
We are already doing, for example, Desiccants, we set up a plant. It is already operational from last month. And two more small investments we are making into primary packaging. So that will be, operational by end of H1. So the thing is, the primary packaging investment is not significant. Each product, it is in the range of, let's say maximum 3 CR. Okay, so we are doing primary packaging investment in a staggered manner as we grow based on the demand for the products.
Understood. Okay. So my second question is, last quarter the reason you gave for the margin drop was the drop in the raw material prices. But then in the November con call you said that the prices are rising again. So in this quarter the margins are still at 15%, and the freight cost has also dropped compared to what we were speaking about last time. So what was the issue in this quarter in terms of margins, and why didn't our margins revert back to that 19-20% operating level?
You are absolutely right. Steel prices started rising from, December and January onwards. But still, lot of ongoing orders in pipeline we were having with a little lesser margin. And the major reason for this margin drop would be margin from exports are almost dropped by 50% compared to last year. Because in Chinese steel price is very less and they are dumping in our major market in UAE. So that was the major drop in the overall margin. And also a lot of new packing contract we started from Q1 this financial year. For that, a lot of employees we have taken in the Q4 of last year. So one is the employee expense was a little higher last financial year because we are building the team for the future expansion and bigger orders. So that was also one of the major reasons.
Understood. So if I can break it down, I believe our export sales in this half would be barely 8 to 9 crores if I'm not wrong, because in H1 we said that we were flat. So I don't think that would have a much significant impact on margin. Secondly, when you say that these new contracts we are getting lower margins, do you mean the packaging side or on the strapping side? So if you can clear these two things for me.
See, a new contract, again, let's say before taking, we start our order, 1 or 2 months back, we have to, arrange the manpower. There is some expenses involved. When we look at a long-term contract, let's say 5-year, 3-year contract, before that, when we do the team building, there are some significant expenses we are incurring. That is having a short-term impact in the expenses, basic expenses. So in the long run, these employee expenses, when we start doing the billing, it will be absorbed. That's what I meant.
So you are saying next year we should be, again in H1, we should be close to 18-20% operating margins without any problem.
Yeah, see, we always try to improve our margin, but now our focus is, increase our top line and take as much as new orders as possible. Margin front, definitely, we believe definitely minimum 15 we can maintain without compromising the current margins.
Understood. Okay. So my last question is, last we talked, we were expecting to convert 200 to 300 crores from the 1,000 crore bid pipeline by March. But that hasn't happened. So if you can explain what has happened here.
See, if you look at the current order book, over 100 crores of order book we are having for the next 3-year timeline. For this year, minimum 50 crore of packing contract order already we are having on date. And like I said, still those large orders which we are attempting, which were in the pipeline, they are still there. We haven't lost any big order yet. Just that the finalization is taking some time. So in June, July, we are expecting a closure of some large orders, which we are dealing for the past 7-8 months. So we are still, sticking on to the same guidance. We're expecting our order book to increase significantly in this quarter.
Understood. Okay. I have a few more questions, but I'll get back in the queue. Thank you.
Thank you.
Thank you. A reminder to all participants, if you wish to ask any questions, you may press star and 1. Anyone who wishes to ask a question, you may press star and 1 now. We have our next question from the line of Asta Agarwal from Agility Advisors. Please go ahead.
Hi. Hello.
Hello, yes.
Am I audible? Hello.
Yes. Yes, please tell me.
Yeah. Am I audible?
Yeah, you're
yes,
audible.
Asta, we can hear you. Please go ahead with the questions.
Yeah. Okay. So thanks for the opportunity. So my question is, what is the rationale behind setting up the CRC mill, given that it is a highly capital-intensive and commoditized business?
Good evening. See, the thing is, as a steel strapping manufacturer, we are consuming about close to 1,000 tons on a monthly basis. And this raw material for steel strapping is a medium carbon steel, which is very difficult to force. Generally, people who are supplying are adding up significant margin because very handful of people can roll this medium carbon steel. So one is as part of the backward integration, we thought of doing a small, capex project only for our captive consumption. But when we did a market research, like Krishca, a lot of big consumers in the market are struggling to get the medium and high carbon steel. So since the availability is very less, there's a huge demand. The margins in these products are significantly higher than the normal commodity grade steel coils. So keeping this market also in mind, we thought of doing a cold rolling complex. And especially in the South India, there are very handful of less than 2-3 people can provide this kind of special grades. And the market is also increasing. So to capture this market as well as to satisfy our captive consumption, we thought of doing a little bit bigger capex.
Oh, okay. Thanks for the clarity. And my another question is, what is the current order book value and the bid book value?
See, currently we are having 14 different packing contracts from 9 customers in India with the order book value currently is about 120 crores.
Okay. And bid book value?
Sorry?
And total value of the book, like right now?
Yeah, the total value is 120 crore for 3 years. For this year, we are having an order book of 50.79 crores.
Okay, yeah. And another question is, can you share details on some of the key orders of the company has bidden for, like customer profile, the size of these orders, and the expected timeline for the outcome?
Madam, very sorry, we are not able to hear you clearly. Can you repeat the last question again?
Okay, yeah. So can you share some details on the key orders the company has bid for, like the customer profile, the size of these orders, and the expected timeline for the execution? Hello?
See, our major customers are large steel mills. For example, we have a significant order from Vedanta, Shyam Metallics, APL Apollo, and like JSPL, SAIL, all the top major primary steel mills are our primary customers. And we also have customers who are manufacturing TMT and wire rods, like Real Ispat, Mivan Steel. These are all TMT manufacturers. So we are doing contract packaging with them also.
Okay. So thanks for answering my question.
Yeah. Thank you.
Thank you. A reminder to all participants, if you wish to ask any questions, you may press star and 1. We have our next question from the line of Jatin Damnia from Swan Investment. Please go ahead.
Good evening, sir, and thank you for the opportunity. Sir, carry on to the last participant questions in terms of CRM. Now, we are setting up a CRM and majority of the machinery has been ordered. So once we commission our CRM in Q4 of FY26, what sorts of savings one can expect on the overall number first? And secondly, the quantity that they will be selling outside, what sort of margin we can get compared to our existing packing and the strapping business?
Jatin, very good evening.
Yes, sir.
The CRM which we are installing is having a capacity of about 5,000 tons per month. We are expecting to consume minimum 20% of it for our strapping manufacturing. Based on the current steel market price, at least 4,000 rupees we are expecting saving per ton, which is about 4 to 5% on the purchase. So in our steel strapping, we are expecting at least 4% savings in the additional margin by doing this CRM. And on the outside sales, which almost 4,000 tons, which we are planning, we are going to focus mostly on the high carbon and medium carbon value order grades. Okay, so the margins are generally a little higher in this segment. So at least we are expecting a 15% overall margin in this outside sales.
So 15. So more or less margin will be in line with what we are doing it right now on the CRM as well on the outside sale.
Yes, sir. That's correct.
Okay. And in your remarks or the earlier part of this question, you indicated that to fulfill the order, we had increased the employee strength in second half of FY25. So is it fair to assume that the current order book is there in our hand, won't require an additional expenses on the labor, and our labor will grow probably at an inflation rate or more or less remain what it was in the second half of FY25?
Yes, sir, you are right. Most of the mid-level team and all enough to do up to 100 crore of packing contracts. But when we do packing contract, like let's say we have to deploy manpower at site, only the people who required in the site level will be required to be added. That is very insignificant compared to the mid-level employees.
Okay. And in terms of the packing, see, last year we did near almost 13 crores of the order. Now, given the order book in the hand of the 51 crores, so, I mean, the guidance that you are giving, which is 25% of the revenue growth in FY26, looks little bit on the lower end. So, how shall one look at the strapping order or the execution of a strapping business and the packing order in financial year 26?
You are right, sir. We are also expecting some more orders in packing contract side. In the strapping side, see, most of our direct customers, we are converting them into packing contractors. So the strapping side, there might not be a much increase in the revenue. And regarding the guidance, we are giving 20% guidance. Even in fact, if you look at even last year also, 20% guidance only they given, but we have delivered almost 43%. So we will definitely try to deliver whatever we are promising over and above that.
Okay. And on definitely, the things that you also indicated in terms of the couple of contracts that you are getting in June and July. So just on the quantum side, can you help us know how big this contract would be so that our revenue growth for 26-27 also look much more on the stable side if we get this order?
See, we are expecting at least another 60 to 70 crore new packing contracts per annum basis. It could be for next 5 years or 3 years, but at least minimum 60 to 70 crore per annum basis will be adding orders this financial year. So currently we are having about 50 crore. So by this H1, definitely we wanted to have a minimum 100 crore plus order book for this financial year in packing contracts.
Right. And last question, then I'll come back in the queue again. In your press release, you had mentioned that after a long struggle, you were able to get a good order. Initial order from the Steel Authority of India, and which need to be executed in the Q1. So definitely that would have got executed. So any further roadmap that we have got from the bigger PSUs in terms of a newer contract, their visibility on that front?
In PFU side, we are doing some trial orders. The thing is, the trial orders take some time to get the approval. We are also supplied some 7 crore worth of material to PFU. So that trial orders also expecting the final approval from the user side. Once that is done, we will be eligible to participate in tenders worth at least 250 crore per annum basis in PSU. Currently, we are not able to participate because we are not having the eligibility. After, like you mentioned, a lot of big struggle, we penetrated and got some trial orders. So very soon, maybe in this financial year, we'll get the eligibility to participate across all the PSU tenders.
Oh, that's good to know that. And so last question on the CRM, what capex that we have spent and how much will we be spending in this financial year?
Close to 40 CR already spent on the capex. Another 40 CR is expected to be done on the CRM plant.
Which will happen in this financial year, right?
Yes, correct.
Sure. Thank you, Bala. I'll come back in the queue again. Thank you.
Thank you, Mr. Jain.
Thank you. A reminder to all participants, if you wish to ask any questions, you may press star and 1. We have our next question from the line of Vijay from Growth Trust Ventures. Please go ahead.
Good evening, Bala. Thanks for the call. So, my question is on your market share. So, we believe that you hold close to, say, 10% market share in the segment. And what I was seeing is the major share is filled by the international players. I just want to understand to what extent you have been able to garner market share during the last quarter or last or second half of the year. And what is your expected target market share over the next 2-3 years?
Mr. Vijay, very good evening. Regarding the market share, our focus is to increase our packing contract market share at the moment. If you look at last year, it's out of, let's say, 2,000 CR, we are hardly having 1%. But by this year end, at least 5%, 5 to 6% of packing contract, we wanted to gain the market share.
Okay. Since you have expanded into, say, UAE and now into Singapore, so what kind of contribution do you expect from that segments or the region?
From exports, we got a roughly 30 crore of revenue last financial year, which is about 20%. So even in this year, we are expecting a similar revenue, at least 20% of our revenue will be from exports.
Okay. So overall, you are saying 20 crores will be overall out of the overall revenue, right?
That's correct, Mr. Vijay.
Okay. So do you have any kind of hedging policy since, I mean, we are getting some, at least it should be around, say, 10 to 15% your exports only or export revenue. So do you have any hedging strategy? Because we are seeing significant volatility in the forex prices since I'm asking.
Mr. Vijay, sorry we lost you in the middle. Can you repeat your question again?
I just want to understand. No, since your export contributes nearly 10 to 15% of your overall sales.
Yeah.
I just want to understand, is there any hedging policy or something you follow?
Okay. You are asking about the forex
volatility, yeah.
We are not having any kind of hedging policy because, we are mostly getting benefited because the dollar is increasing month on month. In our forex receivables, we are last 3 years continuously we are gaining only whenever there is a change in dollar pricing. Hedging is mostly when we import large quantity, that would be a better option. Hello, Mr. Vijay?
Yeah. Okay. So one final question on your
Mr. Vijay, are you saying something? We can't hear you.
Yeah. 1 second. But have you benefited anything from this China Plus One policy? Any impact is there? And I also want to understand, we are seeing a significant volatility in steel prices due to this trade war, ongoing trade war. So is there any impact are you seeing?
Regarding the trade war, you are absolutely right. There is some huge uncertainty is there among the customers in US. We have some 3 customers in US in last financial year, but we were expecting a little bigger volume, in fact. But due to this, lot of confusion in the duty structure and changes in the duty structure, people are a little bit reluctant to order huge volume in this scenario. So that is definitely affecting our growth plans, especially in the US.
Mm-hmm. Okay. So currently, what would be your, of the total revenue, what would be your contribution from the US?
Last year it was, I would say, close to 1.5 CR was from US. But this financial year, we are expecting a little, in fact, a much bigger revenue. But due to this changes in duties frequently, customers are a bit reluctant.
Right. Okay. Fine. Thanks a lot, Bala.
Thank you, Mr. Vijay.
Thank you. A reminder to all participants, if you wish to ask any questions, you may press star and 1. We have our next question from the line of Gautam, an individual investor. Please go ahead.
Hi, good evening. Am I audible?
Yes, Gautam.
Yes,
we can hear you.
Yeah. My first question was on your inventory levels, which has gone up. Is this because of the orders that you see coming, or are you struggling to find the right price?
Mr. Gautam, yes, you are right. By end of March, there was a little higher inventory. It is part of ongoing orders only, and there was no issue or any non-moving inventory, nothing like that. And there was an increase in steel price in the Q1, so we are in having a quarterly agreement with many suppliers. So to make use of the lower steel price in the Q4 of last financial year, we were stocking up a little higher than required. So that is also one of the reasons for a higher inventory.
So it's not because you couldn't find the right price, it's primarily because you're stocking up, right?
Right.
And on the margin side, the new facility which you said would have the backward integration, would that be a primary reason, or could that bring our margins back up from our current rate of 15% to, let's say, 19-20%? Or do we see a higher margin, let's say, by next year's time?
See, the CRM project will be operational by end of this Q4 only. So frankly, the margin from that plant we can see in next financial year.
Yeah. Okay. So by FY27, do we see it touch 20% back again, like 19-20%, or is 15% our new sustainable level?
Mr. Gautam, it is very difficult to make a comment on 20% margin level. But as I said earlier, minimum 15, definitely it will not fall further lower than that. We will be focusing on increasing our top line. So that is our primary goal. So of course we will try for better margins than 15. But right now I'm not able to comment on FY27.
Understood. And I think on earlier call you had mentioned there are, I think, 3 players in the organized market. What would be what's the percentage of the unorganized and organized market, and what would be the competitors' market share here?
See, unorganized market share is very less, in fact, because we are dealing with mostly primary manufacturers. So almost 80 to 85% are covered by organized manufacturers. Unorganized manufacturers are very scattered, and they are primarily catering the TMT secondary manufacturers.
And how much would be our percentage in this whole mix, and how much would be the organized players, if you have the number with you?
You're asking about the market share?
Yeah. Ours and like our competitors, like the number one and number two players and all, like market share as well.
See, the number one player, I assume they are having close to 50%. And we are having between 5 to 10% of market share currently. And this detail will be given in detail in our investor presentation, which will be releasing in a day or two.
Understood. Thank you. That would be my question, and all the best.
Thank you, Mr. Gupta.
Yeah.
Thank you. A reminder to all participants, if you wish to ask any questions, you may press star and one. Anyone who wishes to ask a question, you may press star and one now. We have our next question from the line of Pratik Kulkarni from AKMIL Wealth Management. Please go ahead.
Yeah, hello sir. Thank you for the opportunity. I have several questions, but the first question will be, what was the volume growth for FY25, and according to the order book which you have for FY26, what would be the volume growth for this financial year?
Are you asking about the revenue growth?
Volume growth.
See, minimum 20% we are expecting growth across all our verticals.
Okay. And what was the capacity utilization for FY25? I mean, the new capex which we did recently and which was, gone live in the last total capacity utilization, what would it be?
I think I'm very sorry, your voice was breaking. I'm not able to hear you. Can you say again?
Hello. Am I audible now?
Yes.
Yes, sir. So I just wanted to know the capacity utilization for FY25.
The capacity utilization. Okay. See, we are doing close to 60% utilization overall in FY25. And this year in FY26, we are expecting it to reach 75% average.
Okay. And another question would be regarding the capex, regarding the high specialty steel plant, which would be, going into during Q4 FY26. So I just wanted to know how much would be the time for the ramp up, and what would be the optimum utilization for that plant?
See, to ramp up the plant, I would say it will take 6 months from the commercial production. And
yes.
Since our captive consumption is there, it will be operational with at least 20% capacity from day first month itself. Okay, so we are having a captive 20% market requirement. So I think by end of first year, it definitely will cross 30% to 40% utilization.
Okay.
And this capex, what are the machines we are putting, it is part of the phase 1. And as we grow, and there are multiple plans to do further capex in the similar line to increase the capacity on a staggered basis. So there will be a new addition in the cold rolling mill or some special products. Post processing machines will be adding on a year-on-year basis. So this capacity, whatever we are putting 5,000, it is not that it's maybe in year 2 itself we might add it, increase it a little bit. So it will be an ongoing capex process in the new complex.
Okay. And regarding the product, that high specialty steel product, what will be the customer for this product? What will be the use case? As you have said that it's very difficult to procure in India. So what will be the application for end user industry?
See, there are various automotive component manufacturers, engineering component manufacturers, and a lot of commercial applications also there. So we identified close to some 30 to 40 products also the customer base in mostly in South. We'll be targeting those customers.
And the price of the product, is that product also, that the prices is also volatile like what we are currently facing in our regular products, or is the volatility there a bit different than what we are facing now?
See, any price increase, decrease in the basic steel price, it will reflect there also.
Okay. So basically pass on. Hello?
Yeah. Yes.
Yes. So, okay. So, that's from my side, sir. Thank you.
Yeah. Thank you.
Thank you. We have our next question from the line of Yuvan Jaswani from Mittal Analytics. Please go ahead.
Hi, sir. Thanks for the opportunity. Am I audible?
Hi. Yes, you are audible.
Yeah. So, just one quick question from my end. In the press release, we have mentioned about the order book from sale of 4.85 crore, and it says valid up to April 6, 2025. So, can you help clarify what exactly is this?
So, just a second. Hi, can you say again which order you are talking?
So, in the press release that came out on 31st May, we have mentioned that we have got a order from SAIL Bokaro Steel Plant for 4.85 CR, which is valid up to 6th April 2025.
Correct.
So, is there a typo, or is this a very short-term contract that we have got and we will see some benefit out of it in H1?
See, this is a trial order we got from Bokaro Steel Plant. Generally, whatever the yearly consumption, some 10% of the quantity, they given us a trial order to us. So once we already supplied the entire material, so we are just awaiting for the QC approval. They will consume the entire material and get the feedback from the customers also. It's a little time-taking process. So once that is done, we will be eligible for the main tender.
Got it. And sir, just one more, clarification or better understanding on your order book. So we announced couple of order books as multi-year contracts, right? Like the Vedanta Group order we have announced for 5 years for 47 crores and 3 years some 18 odd crores. While the AKMIL Apollo contract we have mentioned as a 25 crore per annum. So can you just help me understand what is your yearly order book for FY26? And what is your long-term order book wherein you have gotten multiple year contracts? So just a broad breakup of what these two order books look like.
Yeah, sure. See, some customers, they give the PO for long run, like Vedanta, they are given the PO for 5 years, some mentioned the PO value also. So we have taken only the POs, confirmed POs in hand. For example, APL case, we have PO for only 1 year. It will be renewable year on year, generally. But we are not considering the 5 years or 3 years value from that particular order. Only 25 crore we have taken into the order book calculation. Likewise, Vedanta and all, since they already given the 5-year PO, we have taken that into the consideration. So most of the orders, for example, even Sham Metallics also, we have taken only 1 year, but generally we are doing it for the past 2 years. Every year they are giving the PO. Since as per NSECB guidelines, we cannot just consider the order value without having the confirmed PO. So we are going by that. So with that calculation, we are having a 120 crore worth of POs for next 3 years. And for this year, 51 crore worth PO already we are having in hand.
Okay. So 50 odd crore is confirmed order for this year that we are going to execute, and 120 crore is for the next 3 years.
Right.
So some of it will be the repetitive contract for multi-years that we have got already.
Correct.
And in last presentation, we had mentioned about a pipeline of 900 crores. So standing now today, how are we seeing that pipeline?
Currently, see, over, I would say, 700 crores worth of orders we are attempting.
Sorry, I couldn't get it. Can you repeat, sir?
See, the current order pipeline, which we are participating, is over 700 CR.
Okay. And sir, why is there a reduction in this from 900 to 700? Or is it because of some part of this pipeline has got converted?
Yes, we already converted close to 100 CR into confirmed orders. And some orders, let's say APL and all, we had just got 1 year order. We were expecting a multi-year PO, but PO is just for 1 year. So that's why there is a reduction in the pipeline.
Okay. And sir, in the multi-year POs, how do we take care of the escalation of cost? Because the labor cost will keep on increasing, right? So is that built into the contract, or just because we get assured business for 3 years, we take in those cost appreciations on our end?
See, all the major components like steel price and plastics price, there is a price variation class. So based on that, every quarter the value has been revised. That is one thing. Also, based on the state labor laws, the minimum wage also consider in the PO. So any revision in the labor laws, so our service, salaries also we revise. So that is also mentioned in one of the conditions in all the POs. So subject to this, every quarter there will be some slight variation in the pricing in the billing value.
Got it. If I may just squeeze in one more question on your working capital.
Yes, sure.
Hello? Yeah. So, sir, if we look at the year-on-year trend of our working capital and specifically debtor days and inventory days, that has been increasing from 60-70 odd days to 100+ days now. So how are we thinking of these going forward? Specifically on inventory, do we see that reducing? Because in packaging contract, you have mentioned that the debtor days are a little higher. So inventory, where are we seeing those numbers? And in debtor days, is there a scope for any further reduction, or 100 odd days is the norm that we are stable with now?
One is, after we do the CRM, our steel strapping raw material inventory expected to go down significantly. So now what happened, for every size, every grade, we are keeping stock. Once the CRM is there, that steel inventory definitely will go down significantly. And especially by end of March, what happened, we were starting some 4 big contracts, and we have to stock the inventory at site level before we start the contract. So 3 of our biggest contracts started from April only. So that's why the inventory levels are especially high. Also on the receivable side, we have did this trial order from sale. So all those things are as a receivable. So once we complete this and when we start the normal operations, this inventory and receivables will definitely go down.
So safe to assume these can be brought down to 80 odd days again?
See, I would say 90 days would be ideal in the long run.
And once the cold mill comes in, then inventory days would come down to how much?
Expecting it to be about 45 days.
Okay. So major reduction you are expecting through that?
Yes.
Got it. That's it, sir. Thank you and all the best.
Thank you very much.
Thank you. We have our next question from the line of Deep Gandhi from iThought PMS. Please go ahead.
Yeah, hi sir. Am I audible?
Yes, we can hear you.
Yeah. So the first question is just again a clarification on the working capital side. So you mentioned that receivables also increased because of 4 crores of sale order, but that is very small as percentage of our revenue, right? So were there also some other factors which led to increase in the debtor days? If you can talk about that.
Not really, because our last quarter run rate was little higher, especially March month sales was the highest. So that is also contributing to the higher receivable.
Okay. Okay. And so next question is on the export side. So I think you mentioned in the initial question that there is some China dumping which is happening. So if you can talk about that, how is it impacting our business? And just a related question, is there any risk of China dumping also can impact our domestic business?
See, in our major market, Middle East, we are seeing some at least $100 of margin contraction because of the Chinese steel prices. So just to keep the customer base alive, we are compromising the margins on the export because we just entered that region just because of the fluctuations in the pricing. We cannot reduce our volume. So we are just trying to maintain the margin volume, but we are forced to compromise at least $100 in margins.
Okay. And can this something similar also happen in India? Is there any risk of China dumping starting in India also?
India, I'm very confident that situation will never happen because we are very much protected by the government, by various initiatives. There is a very clearly defined BIS. So none of the scrapping manufacturers in the world is having BIS. So I don't see any scrapping coming into India in the future also.
Okay. And sir, you mentioned that this dumping is happening in exports and we want to grow our export business as you mentioned to previous answer. So is there some kind of risk that the margins might fall below 15% if the China dumping increases further, or if we go even more aggressive in terms of building our export business, is that a risk?
Currently, most of our growth revenue we're expecting from our domestic only. And like I said earlier, our exports would be in the range of 20% of our revenue. So out of 20% also, now we are diversifying our revenue by adding various primary packaging material. So we are reducing our reliance on the steel strapping in the export business. We are increasing our share of primary packaging. So we are trying to compromise the reduction in strapping in the export by increasing the share of primary packaging, where the margins are slightly higher than the strapping.
Okay. And sir, just a basic question related to that. So in the past calls, you've explained that for packaging, there's a lot of requirement for manpower. So I mean, how would the export of packaging work? Will we need to have manpower outside India to manage that business?
See, our packing contract is we are doing only inside India. Outside, out of India, we are only supplying the materials. So there is no packing contract.
Okay. Okay. And also just one last question on the steel plant. So I mean, if you can, explain what is the thought process behind setting up this plant, because this might make your business much more asset heavy. If you see, I mean, even this year, the ROEs have already been impacted because of the large capex which we have done for that. And I know you explained to the previous participant that the inventory days will reduce, but won't there increase in inventory days also because you might need to stock up a lot of raw materials for setting up the steel plant in future? So just some thought process, why are we deciding to set up a steel plant, not only for captive, but also for, because you mentioned you want to also introduce newer varieties. So what is the thought process behind this?
See, we always look for opportunities in the market, So, and since we are in the steel business, we are a big consumer of the special steel for our scrapping. We understand there's a gap in the market, and when we know there's a good opportunity in the market, we wanted to capitalize on the opportunity. And market is also growing year on year for the special steel products. So to capitalize on this is the right time. If after 3-4 years, it would be too late for me to enter. So also I got excellent team to support me with this kind of project. So since we are very confident and there's a good opportunity in the market, we decided to go ahead.
Okay. So say for next 3 to 4 years, what kind of CapEx should we expect, just for the steel plant? Because you also want to introduce new varieties. So any number you can share, maybe say for next 2, 3 years, what kind of CapEx you are expecting?
See, apart from the current CapEx we are doing, in 3 to 4 years, uh, there might not be a significant CapEx like which we are doing. Maybe to the tune of maximum 25 CR, which will be done in a staggered manner. So more like from our profits, and based on the market needs, we'll be slowly doing one by one, small value additions into the cold rolling complex we are doing.
Sure. And so you mentioned that there are only 2, 3 companies in India who are able to manufacture these variants. So maybe if you can give some names, which are these companies? And just a related question to that is, are you already in talks with your customers? Do you have any kind of, soft commitments from them that they are ready to buy the volumes from you? Is there anything of such kind in place?
So we have done some significant market research and met some potential buyers mostly in Tamil Nadu, in this region where we are putting the plant. So yeah, I have some kind of soft commitment from people. And in terms of, see, I don't think I mentioned 2, 3 people only doing special steel, mainly in the south. But there are many people in the north of India, and most of the people in south are buying this material from north of India only.
Okay. So is there a logistics cost which they end up incurring and they'll be able to save if they buy from you? Any quantification, if you have done any calculation, how much will they save in terms of, say, percentage if they buy from a player like you who is based out of South India instead of buying from North companies?
Yeah, see, we are closer and we can supply immediately, and there is like you said, 3-4% cost involved with the transportation. So that is.
Ladies and gentlemen, good day and welcome to the Krishca Strapping Solutions Limited H2 FY25 earnings conference call, hosted by AKMIL Strategic Advisors. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. I now hand the conference over to Mr. Sahil Patil from AKMIL Strategic Advisors. Thank you, and over to you, sir.
Good afternoon and thank you. On behalf of AKMIL Strategic Advisors, I welcome you all to the conference call of Krishca Strapping Solutions Limited. From the management side, we have with us Mr. Krishnamurti Balamanikandan, Chairman and Managing Director, Ms. Jagajyoti Naskar, CEO and Whole-Time Director, Ms. Diya Venkatesan, Company Secretary and Company Officer. Now I hand over the call to Ms. Diya. Over to you, ma'am.
Thank you, sir. Good evening, everyone. Thank you for joining us today. I would like to welcome all our investors, analysts, and stakeholders to the H2 Financial Year 25 earnings conference call of Krishca Strapping Solutions Limited. I'm Diya Venkatesan, Company Secretary and Compliance Officer of the company. I'm joined today by Mr. Krishnamurti Balamanikandan, our Chairman and Managing Director, and Mr. Jagajyoti Naskar, Full-Time Director and Chief Executive Officer. We are also accompanied by key members of our leadership team. Together, we will walk you through the company's performance for the second half of Financial Year 25 and for the Financial Year 24-25. Highlight strategic developments during the period and share our vision and priorities for the road ahead. Company overview and performance highlights. At Krishca Strapping Solutions, we are driven by our commitment to excellence in our providing comprehensive packaging solutions for the metal industry. In Financial Year 25, Krishca Strapping Solutions Limited recorded revenue of rupees 151.08 crore, which is a 43% growth in revenue compared to last year, reflecting the stability of our business model and our ongoing efforts to strengthen our presence in the industry. Despite sliding steel price and pressure from the international steel pricing situation in this financial year, our EBITDA stood at 24.29 crore, which is a 20% growth year-on-year. Strategic investments and diversification. The new cold rolling complex project is progressing as per the original timeline with major machinery orders completed. Factory construction is scheduled to begin in this month, with production expected to commence by Q4 of financial year 26. In addition to expanding our steel production capabilities, we are strategically diversifying into other packaging materials. We are increasing our focus on comprehensive packaging solutions, including products like desiccants, tarpaulins, HDPE materials, airbags, and a range of BCI-based corrosion protection products. This expanded product portfolio will enable us to provide better packaging contract services, as we will be using all these items in the various packaging contracts we are expecting to secure. By broadening our product offerings, we are enhancing the value we deliver to our clients and reinforcing our competitive edge in the global market. Strategic contracts and expansion initiatives. Our commitment to growth is further evidenced by the significant contracts we have secured. Our revenue from packaging contract business, which stood at rupees 3.16 crore in financial year 24, has grown substantially to rupees 12.88 crore in financial year 25. As on date, our packaging contract order book is rupees 50.79 crore in confirmed orders for financial year 26 and rupees 120.89 crore for the next 3 years, ensuring strong revenue visibility moving forward. Future growth and market position. Looking ahead, our goal is to sustain our growth trajectory with revenue expected to grow by 25% in financial year 26. Increased order book in our packaging contracts is expected to be a key driver of this growth. The increased product portfolio of other materials will enable us to provide better packaging contract services. This strategic approach not only enhances the value we offer to our clients, but also positions us to capture a large share of the market. Our emphasis on expanding packaging contracts and penetrating high-growth regions positions us as well for future success. We are confident that our investments, both planned and ongoing, in the special steel production facility and diversification into other packaging materials will enable us to meet the evolving needs of our customers and stay ahead in a competitive market. These initiatives are integral to our long-term strategy of building a resilient and diversified business model. In conclusion, these results reflect the dedication of our team and the progress of our ongoing initiatives. With solid future expansion plans, a strong order book, substantial market reach, and industry-leading operational standards, Krishca Strapping Solutions is well positioned to continue building on our legacy of quality, innovation, and growth. We remain committed to creating sustained value, and we are excited about the opportunities ahead. We are grateful for your continued trust and support. We are happy to address any questions and provide additional insights into our journey. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question, you may press star and 1 on your touch-tone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to all participants, if you wish to ask any questions, you may press star and 1. We have a first question from the line of Rahil Dasani from MAPL. Please go ahead.
Yeah, hi, I'm audible.
Yes, sir.
Yeah, hi, Rahul. audible.
Yeah, good afternoon, sir, and thank you for this opportunity. I have several questions. So first of all, what is the purchase of stock in trade of 26 crores? Did this quarter have some revenue of trading of some products and hence this expense? So if you can please explain this.
Yeah. Hi, good evening. See, as part of, the packing contracts, we not only deal steel strapping, we also deal various other packaging material. So, all our customers, they also use these other packing materials. So, we deal with products like HTP, VCI-based products, and lot of dunnage airbags, tarpaulin. So, this it was very revenue was very less last financial year. So, from this year, it was a bit higher. That's why we have given a separate column in the balance sheet to distinguish the revenue.
Understood. Okay. And secondly, I believe in last call you said that you guys will also start manufacturing these primary packaging products. So what's the timeline for that? Would that also be coming with the cold rolling plant, or will we start that primary packaging plant earlier?
We are already doing, for example, Desiccants, we set up a plant. It is already operational from last month. And the two more small investments we are making into primary packaging. So that will be, operational by end of H1. So the thing is, the primary packaging investment is not significant. Each product, it is in the range of, let's say maximum 3 CR. Okay. So we are doing primary packaging investment in a staggered manner as we grow based on the, demand for the products.
Understood. Okay. So my second question is, last quarter, the reason you gave for the margin drop was the drop in the raw material prices. But then in the November con call, you said that the prices are rising again. So in this quarter, the margins are still at 15%, and